Okay, so some of these questions here that I've put up front dealing with pensions are probably easier than what you'll see on the test. But again, part of what I'm trying to do is just to remind you of some of the key concepts so that then when we're working the questions, they make a little more sense. So accounting for defined contribution plan, right? We talk about defined benefit plan, defined contribution plan in Chapter 17. And remember that the accounting for the defined contribution plan, where the employer just agrees as to what they're going to contribute each period, is easy because you simply debit the expense and credit the cash for whatever you contribute to the employee's behalf at that point in time. So it's much easier from the company from accounting standpoint, liability standpoint, etc., right? Now, if you're the employee, from the employer standpoint, if you're the employee, you may not like this as much because now you bear all the risk of your pension assets growing, etc., and being sufficient to pay your retirement. But this has been the trend now as most companies use defined contribution plans. So even though we don't talk about it much in Chapter 17, it actually is what the more prevalent type of plan out there now. Okay. Now we take a look, and to help assess the uncertainty that surrounding defined benefit pension plan, corporations frequently hire actuary. And I only put that up because I think there's some people in here thinking about actuary as an alternative career to accounting. And so there you go. Well, there's one of the things you'd be doing. Okay. All right. So that's the main reason I put that up there. When I saw actuary in there, I thought of you, and I thought, oh, I'll put this in there. Okay. So anyway, the employer has an obligation to provide future benefits under the defined benefit plan. And this is what generates all the liability and risk for the employers. And this is why a lot of the employers have now gotten away from these defined benefit plans. More of them use the defined contribution plans, right? Then come over and we take a look at, I'm still struggling with the spacing on some of these. I don't know why they give me so many pages in between, but in a way it's good because it gives us some room for notes and stuff. But we take a look at this number 4 now, and we have this company that has a defined benefit plan, and they have their projected benefit obligation of $265,000 on January 1st. During 2018, they paid pension benefits of $4,000. We have a discount rate, interest rate for this at 10%. Service cost for 2018 was $80,000, and the plan assets fair value increased by $45,000. And then we ask, what is the PBO at the end of the year? And remember, there's that one slide where we sort of show the connection between the PBO and the plan assets and then the service cost in the middle, right? And remember, I said that's an important slide. So make sure you're looking at that slide, because that would have shown us here, like you see in the solution, that you start with the PBO's beginning balance, where our liability increased for the current period's service cost. Our liability is increased for any interest, and the interest is based on the beginning balance of $265,000. And then our liability is decreased here for what? For the benefits that are paid out. Okay. Now, in this particular one, they didn't give us everything. For example, we could have an increase in the PBO if we had some sort of prior service cost that had been calculated at the beginning of this year. We would have gone ahead and added that in. It doesn't have to be the beginning of the year, but during this year, if we had calculated prior service costs, that would increase our liability as well. So it's important. Do you want me to put that slide up as a reminder of the slide that I'm saying is important, or you know it? I'll put it up, okay, because it is, I think it's a good slide, because it really does help answer quite a few of the questions I'm planning to ask. So what is it, Chapter 17, right, is pensions? And it was, and I put it, it was such, I felt it was of sufficient importance. I think I put it in there twice. Okay, but it was basically this one. I'm not going to go in the slideshow. Let's get set going. The slideshow. It's a little easier to see. Okay. Now they're going to make me click again. No, there's. Okay, so we have what? We have our PBO, beginning balance, right? And as we just saw in that question, plus what? Service cost will increase the PBO. As we saw in that question, interest cost increase the PBO. And as I was saying, if we had prior service cost, that would also increase the PBO, right? So once we've made an amendment to the plan and we are going to retroactively consider service already provided in that amendment to the plan that we're giving, that increases our liability. And then if we have gains or losses from our actuarial assumptions, for example, instead of assuming that we're going to have the individual making $420 a year, we push it up to $450 or whatever. That would then be an amendment to the plan that we would have to consider. Okay, and then not an amendment to the plan, but a change in our actuarial assumptions. And if it's going to increase our liability, we'd add it. If it's something that decreases our liability, I don't know, people are going to get a cut in pay or something, or we decide they're not going to live as long, whatever, then what? Then we would go ahead and subtract it. So we either add that one or subtract it, and then like we saw in the problem, less the payments to the retirees. Now, change in plan assets, the beginning balance, and remember, most companies choose what? The expected return in order to smooth their costs on their income statement each period. And then gains or losses are basically going to affect this, so that we ultimately will do what? We ultimately will have the actual return on plan assets, right? That will be an add or you subtract if it's a loss, plus any cash contributions that come in, and then of course payments out of the plan assets are subtract. Okay, so let me make that clear. That when we're talking about the plan assets that we're doing the accounting for, it's what? Actual return, right? It's the actual return. When we're talking about our service cost for the period, our pension expense, I should say, it's service cost plus the interest, and then minus what? Minus the expected return. So if we're calculating plan assets, it's actual. If we're calculating pension expense, it's the expected. And then for our prior service cost, and then the amortization of gains and losses, and those gains and losses are going to be what? Going to be the accumulation of the difference between my expected and my actual. Those get what? Amortized into our pension expense. And remember, we had the corridor approach for determining the gains and losses, any amounts in excess of 10% of the greater of the plan assets or the liabilities, divided over the average service life of the employees, will get amortized in each period. And for our prior cert, and that's the case with both of these gains and losses, both the ones that affect the PBO and both the ones that affect the plan assets. And then for our prior service cost, it's whatever the prior service cost is, amortized over the average remaining service life of the employees. And while those items are being amortized in, they are affecting my accumulated other comprehensive income, right? Okay, so I thought that was a good slide because it kind of gave us some of the key elements you'll see here for some of these questions. Okay, and that was the case with that one. Okay, now it didn't have all the elements. It just had the beginning plus the service cost plus the interest minus the benefits paid for calculating our PBO. Okay, any question on that? Okay, good. Let's take a look at number 5. The component of pension expense, the results from amending pension plans to give recognition to prior services of currently enrolled employees is the amortization of the prior service cost, right? Okay, and we make the amendment to the plan and we make that retroactive from the date these individuals started. It increases the PBO, but its effect on what? On our pension expense is the amortization of that prior service cost. Stop me if you have a question, guys. Arthur's not here, so somebody's going to have to pick up that mantle, okay, if you want to ask questions, if you want me to stop and clarify something. Okay, take a look at number 6. The following information is related to the defined benefit pension plan of Simpson Company for the year. And they give us a whole bunch of stuff, right? You're looking at that, you're thinking, God, that's got to be the most complicated multiple choice question in the history of schooling, right? In the history of testing. And we say, assume no other relevant data exists. What is the pension expense? Well, that's not as bad because what? They're just asking us to go through this table and pick out those items that affect service pension expense. And remember, we had that SIR age, okay, if you wanted to try to remember some of the key ones. So are we going to pick up service costs? Question mark? Are we going to pick up service costs? Service costs we know is going to affect it. Good. Contributions? No, that affects what? The plan assets, right? How about benefits paid to retirees? Well, if it's a defined contribution plan, we'd be about done. If we consider those contributions, we'd be about done right here now, wouldn't we? Okay, but no, that's going to be what? That's going to affect the plan assets and the PBO. It's going to reduce it. Plan assets fair value. Now we are going to be interested in this. Not that we're going to add it to our pension cost, but it would do what? Our pension expense, but it would do what? It is the base that we're going to be using to calculate our interest, isn't it? Okay, so we might throw that one off to the side. Plan assets, no. Actual return on plan assets, well, what's going to happen? The actual return on plan assets actually reduces my pension costs, right? So I am going to be interested in that one. Okay. PBO at January 1st. So I think I should have circled this one. I want to circle what? This one is where I'm going to calculate my interest. PBO at the end of the year. Discount rate. I'm going to have to pick that up. And then what? The long-term expected return, since they're telling me what? 9% is the expected, then I'm not going to use what? Actual, I'm going to use the expected, right? So I do use this one, okay? All right, so let's just look at the solution because I think that's a little easier to figure out what's going on here. And we pick up what? We pick up the service cost. We pick up the interest cost, which was the beginning PBO of 800,000 times the 10%, right? Okay, and then what? The expected return is what we pick up. And so again, the plan assets fair value times the expected return of 9%. That reduces my pension costs, and I use the expected. Now, this one, I'm of the opinion that this question should have been written a little bit more carefully, because how do I know that I'm supposed to use the expected? I mean, is there a law that says I'm supposed to use the expected? Most companies choose to use the expected, don't they, in order to smooth the profit? So I think this question would have been better if it had said that, right, that the company chooses to use the expected. Okay, so if you're working that question and the question doesn't call out to you whether or not they're supposed to use the expected or not, you need to make sure and ask me that question, right? I don't know why I did that. Hello? Okay, so ask me that question. Okay, I was afraid for a minute I wasn't recording. So ask me that question, okay, if the question is ambiguous on it, because frankly, it should come out and tell you that they've chosen to use the expected, right? Question? Okay, good. Let's take a look at these now, and we're kind of done with pensions. And remember, guys, I said what? How many multiple choice? 25? 25 multiple choice, and I'm thinking what did I say? 5 pensions, right? And maybe 5 of those. And by the way, there's none of the convertible bond questions because I think we kind of covered that last time in this practice exam. But don't forget, I'll probably have 5 of the convertible bonds and the bonds with detachable stock purchase warrants. Not 5 each, but 5 total, covering those 2 subjects. So that leaves us what, 15? and we'll probably have a split then between the lease questions and the deferred taxes. So that's why I kind of loaded up again here with deferred taxes and leases in this practice midterm, just so that we are getting as comfortable as possible with that stuff. Okay, so we have this company, and the company has this pre-tax accounting income, and then they start calling out to us some some permanent differences which are not deductible for tax purposes. Then they have depreciation expense for what? For book purposes of 70, but for tax purposes using Mackers, whatever, they are showing 110,000. A little bit of an accelerated depreciation going on here. Now, again, guys, I just want to make sure I'm clear. I have no expectation that you are knowing tax law as to what's deductible for taxes versus what's not deductible for book purposes. I don't care about that. So you need to ask me if you're not sure whether or not something is, from a tax standpoint. I will tell you, this is saying that you would take it on the tax return, you wouldn't take it on the books, okay? Then I expect you to know what to do with those differences, right? Now, if we're calculating the taxable income here, was what they wanted from us, we're going to do what? Start with our accounting income, which they told us to be 200, and then we're going to go ahead and do what? Subtract out that permanent difference. Now that permanent difference is subtracted out in figuring out the taxable income, but we will ignore it when it comes time to calculate our deferred tax liability. And we're going to see how that's going to work here in a minute. And then we have the temporary difference for the depreciation. So the taxable income is what? 165? Right? Question on that? I forget my student that was having a little trouble with that concept. She's not here today. I think she has something else on Fridays. But everyone's clear with that? Okay. Okay, good. So we get that 165, and then we say Franklin experienced, and you look at this and you're like, okay, a tax liability, tax liability, tax liability, a tax benefit. They are, you can get rid of D right out of the gate here, right? There was no net operating loss. That's nonsense, okay? But they're asking me about the tax liability, which is the amount that I'm going to send to IRS, isn't it? Okay, and so I go ahead here and I say, okay, well, look, if the taxable income, and they kind of did the calculation again of taxable income here for us, but the way I would do this one is I would just go ahead and pick up my 165, which was the taxable income from the previous question. Right? There's my taxable income. And if I want to figure out what I'm going to have to pay to the IRS, I'm going to do what? Pick up my tax rate. Okay? So I go ahead and I pick up the 165 times the 0.4. That gives me the 66, doesn't it? Okay? So that becomes my check that I'm going to send to the IRS. That's my current tax liability, right? Okay, then we come down and they say, okay, what is Franklin's net income? Okay, what is NOL? Net operating loss, which they did not have here. Remember, we have a net operating loss, and I don't think I gave you any of the questions like that in this one. We did a couple of those last time. Net operating loss, we carry it what? We carry it back 2 years and forward 15? What is it, 15 or 20? I can never remember. 20? Huh? It's 20 now? Okay. It used to be 15. Okay. So we didn't have that in this question. So, like I told you the other day, was I telling you guys about this? They give the creation of these tests to graduate students, right, that are sitting there trying to hurry up and get this done so they can check off that they worked for McGraw-Hill, for a year, 6 months, doing this kind of stuff. And sometimes even when I write questions, because sometimes I'll help prepare CPA review questions for students, and the right answer is always easy, right? And then you have to come up with 3 dummy answers, and by the time you're getting to that 3rd dummy answer, you're saying, I don't know, and you just throw anything in there to kind of finish it up, right? So obviously, there's usually one that's like way off. Okay, and you can get rid of that one. But anyway, 165 times 0.4 is our taxable. Okay, and then they wanted to know our net income for the period. Now, the way I would go about doing this is I would sit here and say, okay, first, I want to figure out what my deferred tax is, because I know that I'm going to do what? Take my current tax payable plus the deferred tax. That total is going to then be what? Be my tax expense. And once I have my pre-tax accounting income minus my tax expense, that'll be my net income, right? Okay, so let's go ahead and let's figure out that deferred tax. And if you come down a little bit, if you come down here a little bit, you start to see what? That they make us figure out the deferred tax. I thought, yeah, they want us, it's using the same facts, we want to get the deferred tax. Okay, and to get the deferred tax now, we're going to do what? We're going to take those future taxable amounts. And so for us, the future taxable amount was what? Was the 40 temporary difference. They told us there was a 40 temporary difference going back up, that I've kind of drawn a line through here. That 40 temporary difference. Okay, and the 40 temporary difference times the tax rate gives us the future tax, is the future tax, right? The deferred tax. Okay, so you take the what? Future taxable amounts here, which is this 40 times, why am I writing it again? I don't know. Times 0.4 gives me what? 16 as my deferred tax, right? Okay, and to get the tax expense, I'm going to do what? That tax payable that we calculated previously, plus what? Plus the deferred tax liability gives me what? Gives me a total tax expense of 82, doesn't it? Okay, now just to put that in the journal entry that we looked at before, we would credit tax payable for 66. We credit what? Deferred tax for 16. And then we go ahead and we've been saying our tax expense, right? Okay, now when we record our tax expense, we should record it into what? Show both the current and deferred tax expense. So my current tax expense is what? 66. My deferred tax expense is this 16, right? That part's deferred. Okay. Now, they're not showing us the income statement here. They're just showing us how to calculate the right answer here, which is to take the 200 taxable income minus the total of my tax expense. But on the income statement, I call it out as to whether it is deferred or current, right? Okay. And then, obviously, my accounting income minus my tax expense is my net income. Question on that? Okay, so we come down, we say which of the following will be disclosed related to our income tax expense, and the answer here is what? C, as I just showed you up there, both the what? Well, I didn't show you there because that was the journal entry. Let's just make the income statement just so we're clear. We'd have what? Pre-tax income, what was it, 200? Right? And then we would have less what? The deferred. Well, let's put the current. I think typically we put the current first. Less the current tax expense. Okay, and this is getting a little redundant, I understand, guys, but I'm just showing you this is how it would show up on the income statement, something like this. And the what? Deferred? Of 16. And then, of course, we would show our net income of 118, which was the answer to the previous question, right? I'm just showing you this is the presentation on the income statement, and that's what this question was getting to, that you understand that on the income statement, we have to show both the current portion and the deferred portion, right?
I want to write the current tax expense and the deferred tax expense during the tax, or just we can write the tax expense.
It needs to be disclosed, meaning that if you just were to show the total tax expense of whatever that would end up being, what, 72 or 82, okay, 82. You could show the total, but then there'd have to be a footnote disclosure that would show the current and deferred. Most of the time, I think what I see, and I'm not a guy that's why I want Doughton to do that stuff with you guys, to show you what some disclosures look like, because I'm not a guy who pours through SEC filings and looks at all kinds of different things. But my sense off the top of my head here is that most companies would show you the current and deferred portion of the tax expense, because that deferred, you know, if I'm a company with a lot of fixed assets, and I'm using Macker's depreciation, okay, and I'm constantly buying new equipment, then the reality is I'm never going to have to pay that deferred, because I'm going to just keep buying new equipment, and I just keep pushing that future taxable amount further and further out into an indefinite period, right? So from an investor standpoint, you'd look at that deferred and you'd say, well, with the nature of this company, they'll never have to pay that, right? And that's a liability that you can also, the deferred tax liability is a liability that you can look at a lot differently, because the chances that they're actually going to end up paying that may not be very likely. That's part of the reason that a lot of companies resisted the idea of getting rid of the last in, first out inventory method as a method that was acceptable for book purposes. Because if they did, all of a sudden they were using that for tax purposes, and all of a sudden they'd have to stop using that for tax purposes, and all of a sudden the deferred liability takes on a whole nother look, because you're not able to have that tax advantage going out indefinitely into the future, and they would have to all of a sudden start paying on that liability, right? And so anyway, okay, it would become a liability that they're obviously going to have to start paying on at some point. Okay, so let's just go ahead with what, number 11. And we've got what, Franklin's balance sheet at the end of its fiscal year would report, and we know we have what? We know we have a deferred tax liability. Remember, if we have an asset and a liability, we would net them and we would report them as what? Non-current, right? Okay, so since we only have the deferred tax liability, then it's just the deferred tax liability. If there was an asset, we'd net it, right? And then report it non-current. Okay, so that's a pretty good little question, I think, in that it's multiple choice questions, but it tests a few different concepts. Okay, any question on that? Okay, good. Let's go ahead then and let's take a look at some of these lease questions. And we're trying to get the interest entry here on January 1st, 2018. Callaway Company leased a machine to Zone Corporation. The lease qualifies as a sales type lease. Callow paid $240,000 for the machine and is leasing it to Zone for $34,000 per year, an amount that will return 10% to Callaway. The present value of the lease payments is $240,000. So what's happening? This is the situation where we're just trying to make the money off the profit, because make the money off the interest, because we're simply doing what? Selling the machinery for its cost, aren't we? Okay, so we're just trying to make the profit off of the interest. Now, just to, before we answer this question, when we first sign the lease, we'll debit what? Lease, L-E-A-S-E, lease payments, what? Receivable for $240,000. Right? That's the lease payments receivable. We're the seller here, aren't we? And we'll credit what? Equipment, whatever that we have sitting there for $240,000, whatever it is we're leasing them, a machine. Okay? Okay, good. So we went ahead and did that. Now what's going to happen? Then we're going to go ahead and we're going to make that first payment, and they tell us that the first payment is going to be made on January 1st, 2018, at the same time that we signed the lease, right? So we signed the lease January 1st, 2018, and the first payment is made January 1st, 2018. So is any of that going to be principal? I mean interest? If you make the first payment January 1st, 2018, and you're signing the lease on January 1st, 2018, that first payment is all principal, isn't it? Right? So we go ahead and we would debit the cash for $34,000, and credit the lease payments receivable, right? I can't spell lease. Now, some people would say, well, why didn't you just reduce the lease payment receivable and just credit the cash for the difference? And the answer is because I'm trying to show you how this is working, right? But that entire amount went against the principal, right? Went against the receivable. Okay, so what happens? For that first year, we carry how much? And I'm just going to come down to the calculation. The 240 minus the 34 that all went towards principal, right? So at this point, we're carrying this 206 for the first year times 10%, right? Means that our interest revenue is going to be $20,600. Okay, so when you look at this and you're like, okay, I can get rid of this one. I can get rid of this one. And then you look at these, oh, I can get rid of this one. Thank you, God. Okay, they didn't even give me one. I thought maybe there was a couple where they credited the right amount to interest revenue, but they didn't. So that's an easy. Could have got rid of all of them that way, right? But just to understand the debit to the interest receivable here is what's going on here. Well, that next payment isn't coming in until what? Until January, isn't it? So at that point, our interest is receivable, right? So we debit interest receivable and credit the interest revenue because we're not going to get that until the next day, right, in January? Okay. And so then what? Then they go ahead and January 1st, they pay us, don't they? So we'll get cash of $34,000. We'll go ahead and we'll credit what? Interest receivable now because we're getting that. That's for the $20,600 that we had just set up right here. Right? We've received that interest now. Okay. And then what? Lease payment receivable will go against, will be credited for the difference, right? Okay. Can you guess why I put that question on the practice test? That was the question you asked me yesterday, right? So that was a good question that you asked yesterday because here's an exam question that's covering the question you asked me. Okay. Okay, good. Come over and any question on that? LPR is lease payment receivable. Okay, good. Let's go ahead then and let's take a look at number 13 now. And they give me this information. January 1st, 2018, Princess Corporation leased equipment to King Company. The lease term is 8 years. The first payment of $675,000 was made January 1st, 2018. So that's all going to go towards principal. And I'm saying that because I know they're going to ask me the interest revenue on this. The equipment cost the corporation $3,600,000. The present value of the lease payments is $3,960,000. So they made a profit off of the sale, didn't they? Because they're selling the equipment for more than their cost, and they're going to have this interest. So assuming interest rate is 10%, how much is the interest revenue? But then they get cute and they go what? They go for 2019. So I'm going to have to go through 2 rounds of calculation here to get to the interest revenue for the second year, right? So they call it, they listed the steps here, but let's just look at how they did this. We have the $3,960,000 is the present value of the lease payments, right? So we picked that number up. And then they tell us that the payment, first payment was made what? January 1st? On January 1st, the lease term is 8 years. The first payment of $675 is made when? On January 1st. Oh, I could change the colors on that. Okay, I'm going to stick with red. $675,000 made January 1st. So that whole amount is going towards what? Is going towards the principal, isn't it? Okay, so for the first year, the receivable that I'm carrying is this $3,285,000. I multiply that times the interest rate, and that is what? That is the interest for the first year, this $328,500. My lease payment is $675, and I do what? I subtract off the interest off of that, and the remaining amount goes towards the principal, right? So then I take the what? The previous carrying amount minus the principal reduction, and that gives me the carrying amount for the second year, 2019 here, right? I multiply that times 10%, and that gives me my interest expense for the next year, for 2019 now. Question? Okay, good. So the answer here is what? 293 something? 850? Okay. Okay, good. Let's take a look at number 14. The lease option to purchase a lease asset at a price that is sufficiently lower than the asset's expected fair value, so that the exercise option appears reasonably certain, is called a bargain purchase option, right? And the assumption is that I'm going to take a bargain purchase option. Hey, you can buy this Porsche at the end of the lease for $300. Okay, you're definitely going to do that, right? Okay, because even if you don't like the vehicle, you can probably sell it for more than $300, right? So you're going to just go ahead and take that bargain purchase option. Okay, now we come over, and that's the answer to that one. And I'm kind of setting you up for some questions that are going to come here now. Okay. Oh, when we have a bargain purchase option, are we going to keep the asset? Presumption? The presumption we're going to end up with the asset, right? We're going to get the asset. Okay. So when we go to use our depreciation, will we use the term of the lease or the life of the asset? No, if we are treating it, first off, we have to treat it as a finance lease. Let's start with that, right? If it's being treated as a finance lease and we're trying to figure out what period we should depreciate, amortize our right of use asset, is the name of that account, okay? We have to sit there and we have to ask ourselves, well, why are we treating it as a finance lease? Are we treating it as a finance lease because there's a bargain purchase option or an ownership transfer? Or are we treating it as a finance lease because what? We're in the substantially all of the is it remaining life or fair value? It's the fair value and the estimated life, and I can't remember which one they say substantially all on and which one they say.
The life is major part, and you say substantially all of its fair value.
Okay, so substantially all the fair value or major portion of the remaining life? Okay, so if it's what? If it's substantially all the fair value, thank you, or major portion of the remaining life, then what? Then we would use the term of the lease because we're not going to end up with that asset at the end, right? If it's what? If it's bargain purchase or ownership transfer, the assumption is we're going to take over that asset, so we should use what? We should use the life of the asset, right? Okay, so you read this question, XYZ company leased equipment to West Corporation or a lease agreement that qualifies as a finance lease to West, but not as a result of a bargain purchase option or title transfer. So they're setting us up, expecting us to know now when we depreciate this asset under finance lease, we're going to use what? Term of the lease, right? Right? Okay. So we look at this, we say the expected economic life of the asset is 7 years. Term of the lease is what? 5 years. So we use the term of the lease here, don't we? Okay. Okay, good. Number 16. Warren Company received a right-of-use asset of $800,000, 10-year finance lease. Interest rate charged by the lessor. The balance in the right-of-use asset after 2 years will be. And guys, this gets a little frustrating because you sit there and you feel like, well, tell me the life of the asset. Tell me if it was acquired under bargain purchase option. Tell me if it was required under, if there was a ownership transfer, if it was the major part or substantially all. And then give me the, give me the life of the asset and not just the term of the lease, right? That's the accountant in you calling out for details that you need to really know what you're doing here, right? And this question doesn't give it to you. It just gives you what? 10-year finance lease, so you have no choice but to do what? But to sit there and just use the only thing that they give you, which is the what? Term of the lease, the 10 years. Okay? Now, this is not an operating lease, is the key takeaway here. If this is an operating lease, then we're going to amortize that fair value use asset just like we would amortize the liability, right? Just like we amortize the liability. Difference between the amount that goes towards interest and the amount that cash that we get amortizes the liability and what? At the same time amortizes the fair use asset, right? Okay, so this problem was really trying to bait you into maybe doing that approach, but if it's a finance lease, we don't do that, right? We use, again, if they have given me the life of the asset and told me it was bargain purchase ownership transfer, life of the asset. If they had given me the life of the asset and told me, though, it was the substantially all of the fair value or the major portion of the life, then I'd use the term of the lease. Okay. I mean, that's not, okay, sorry. I was going to say that's not very useful feedback, but it is somewhat useful in that what? And I didn't pay attention to that, and that's an easy mistake to make. So be careful, you know how long we're asking you, because we said what? 2 years, right? So it's 80,000 a year, 800,000 minus what? 160,000 is how they got that answer for the 2 years using the 10-year life. Or 10-year period. Okay. Come over and let's take a look at this red company. And they make payments at the end of each year. the balance in the lease payable after 2 years. And this becomes another one of those sort of questions that get a little bit involved here. So let's just look and see. They show it to us here in journal entries in this one, but we have 2 years that we have to go by. And so we have the payments, 100,000 right of use asset, payments 1675, and they're being made what? At the end of each year, and we have a 10% interest rate. So we're going to have interest expense of 10,000 that first year, right? And 675 will go towards the carrying value, right? Hello? Okay, so we're done, guys? You don't need to do the rest of this? I don't want to talk to myself. I can go home and talk to myself. Are we understanding this or no? Yeah, we're good? Okay. So we have this what? We have this 100,000 minus the amount that went towards principal, the 675. And so we now have a carrying amount of this 990 something thousand. And we multiply that times what? 10%. That's the interest for the next 6 months, right? Or next, not 6 months, but the next year. And so we go ahead and multiply that times the 10%. Difference goes towards the what? Towards the payable. And so the payable after 2 years would have been would be the 100,000 minus the 2 principal reductions, right? Now notice here, guys, this was what? This was a finance lease, and we're accounting for the liability, aren't we? Okay. Now, is this a similar fact pattern? If it's if I'm asking the amortization on the asset, what is it? This was asking the payable. How about amortization on the asset? Huh? Okay. No. What? They didn't give me any salvage value here, so I don't have to worry about the salvage value. I'm sorry. If you're thinking it's one of these answers, I don't know, because I'm not looking to see would it be one of the other answers here. If they're asking me the depreciation on the asset, because it isn't one of these. Finance lease, 10-year lease. They don't tell me anything about the life of the asset, do they? So what should I do? Well, what did I do up here? Maybe that's why you said 80,000 from the previous problem. It was what? 800,000 divided by the 10 years, right? Right? Okay. So if I'm sitting here and I'm telling you I'm asking you the depreciation going off of that problem, what would you do here? I would take the 100,000 and I would divide that by the only time period they give me here is 10 years, right? Now, if they had given me the life of the asset and it was saying that there was an ownership transfer, bargain purchase, I'd use the life of the asset. If they didn't tell me that and they told me it was substantially all or major portion, I would use the term of the lease, right? Okay? Okay, good. Now, the reason I point that out here, even though they didn't ask for it here, is when you look at this problem now, same facts, but what do they do to us? Now they tell us it is an operating lease, and they want to know the balance of the right to use asset. And if I were to put this question for you on the test, a way to save time, assuming you were having a time issue that you wanted to save time for, would be to take the same answer, wouldn't it? Isn't that how we amortize the right to use asset for an operating lease on the same schedule that we amortize the liability? Okay? And in here they're giving me all of the journal entries, which is to do what? That one we saw from the previous problem, which is for the interest expense, and then we're doing what? At the same time, we're taking the amortization of the asset, right? On the same schedule, okay? Now, they're showing these as two different line items, but we saw in the slides that we actually would report that as one line item, right? Add those two together and report that as one line item. And the whole point here was, again, FASB trying to help out the company on the income statement, saying to you, okay, you know what? Since it's an operating lease, it's going to look like you're just making payments month to month or year to year, whatever, on this lease, right? From the balance sheet, though, it looks different because there is this liability that's sitting here now that's having to be amortized. It used to be in the old days, if you had an operating lease, which most leases were, you just had to report the expense, okay? Now, most leases are what? Operating leases, because think about it. We don't get into the capital lease arena until what? Until the present value of the lease payments is substantially all of the fair value. On that substantially all used to mean 90%. And the major portion of the life, 75%. So there's a whole bunch of time between 0 and 90%, present value of the lease payments being equal to 90% of the fair value, in which you would still treat something as an operating lease. So most leases end up being operating, and companies weren't having to put any kind of liability on there, right? In fact, if you were a company and you were smart, you'd set up the lease terms so that you come just short of the 90% or just short of the 75% to avoid putting that liability on there. Well, FASB looks at that and they say, well, that's not right. The company's decision as to how to structure the lease shouldn't determine whether or not they get to report a liability on it. So now they have to put a liability, even if it is an operating lease, unless it's a short-term operating lease, and short-term meaning a year. And very few leases would be a lease of 1 year. Usually the lease carries on for longer than that. Okay? Okay, good. Now we come over and we say, why classify a lease as a finance lease? And one of the reasons would be what? The leasee obtains control of the asset, and that's a different way of saying what? Ownership transfer or bargain purchase. Question, guys? Because after we're done with this number 20, I don't have anything else. So if you got something you want to get off your mind, this would be the time to do it. Or after this question, I guess. Okay? All right. So I don't know about you guys, but I would observe here that I've given you 2 practice midterms, and both of them, your free response question was what? Deferred taxes? What does that mean? I'm probably going to ask you a question on deferred taxes on the exam. Again, guys, the reason I'm kind of hopped up on deferred taxes more than the others is any company, if they have books and they have tax returns, then they have what? Deferred taxes, right? And would be using this approach. So I'm gonna hit on this a little bit more. Okay. All right. So let's just go ahead and let's take a look at this. And they ask us to prepare the journal entry. Oh, well, maybe we should read the facts. Okay, so North Dakota Corporation began operations in January 2017 and purchased a machine for $20,000. North Dakota uses straight line depreciation over a 4-year period for financing, for our financial reporting purposes. Now, let me ask you one question off the top, okay? And when I teach introductory at the community college, I have to show this, but I just want to make sure we're all on the same page. 1 divided by 4 is what? 25%, right? Okay, just making sure, because I've had students say, wait a minute, why would it be 25% if it's a 4-year life? That's 25% a year. I'm not trying to insult anyone, but I've just been stopped before on that. So, okay. So we have this 25% that we're doing over 4 years, right? Okay. Now they tell us that for tax purposes, the deduction is going to be what? 50% in 2017, 30% in 2018, and 20% in 2019. So they're going to fully depreciate this asset after 3 years, aren't they? So we're going to have that what? Future taxable amount then is just that 1 year, that 4th year in which we finally what? Catch up to the accumulated depreciation, to the accelerated depreciation, excuse me, and take that additional $5,000 as a what? Book deduction, but we don't take it for tax purposes in that year because we've already depreciated the asset entirely. So there's $5,000 of a future taxable amount here, isn't there? Okay. Now we come over and we say the contract rate is of future taxable amount essentially for that last year. Not for the whole thing, but for that last year, there's a future taxable amount of $5,000. Now we say that what? We say that pre-tax accounting income is $150,000, which includes interest revenue of $20,000 from municipal bonds. Are municipal bonds taxable at the federal level? They are not taxable at the federal level, so that's going to be a permanent difference, right? And then they give me an enacted rate of 30%. That's the only rate they give me, so I don't have to worry about it. If they gave me what? A current rate and an enacted rate that was different, then I'd have to use the enacted rate for whatever years the enacted rate applied to. But here they just give me that's the only rate I can use, so I have to use that rate in this question. Okay? So we go ahead and we first want to calculate what? Our taxable income, and our taxable income is going to be what? Is going to be the accounting income of $150,000. We take out what? We take out the municipal permanent difference. That's never going to be taxable. And then we're getting the depreciation versus what? Versus the book difference. And that difference is $20K minus what? Minus the 50% that we'll take in the first year, right? Versus the 25% we will take every year for this asset, right? Okay, so the taxable income is $125, isn't it? With me so far? We take that taxable amount times the enacted rate of 30%. That gives me $37,500. There's my journal entry to my income tax payable. I'm going to send a check to the IRS for that, right? Okay. Now I have to come up with the deferred tax liability, and I have to do what? I have to look into the future and see what are the future taxable amounts, right? And the only thing I have is that last year of $5,000 in which what? I will finally catch up to my accelerated depreciation, right? So we take that $5,000 for that last year times the 30%. That gives me $1,500 as my deferred tax liability, right? Okay, so I go ahead and I take that $1,500. That's my deferred tax liability. Those are my future taxable amounts, right? Okay, that's when I'll have that additional $5,000 that gets taken for book purposes that has already been taken for tax purposes at that point. Okay, and so I've got this $1,500. I add those two together, and that becomes my debit to my income tax expense to balance the journal entry.
Is the $5,000 in the last year just to receive the depreciation difference?
Yes, that $5,000 is finally when the depreciation difference is fully reversed. So remember when we looked at them before, we had a schedule in which we would go year by year, but the amount that was the future taxable amounts was the net of those years. Okay, so the net of the years is what? That last $5,000, because we take 50% the first year, but then we start taking a little bit more using straight line. With accelerating those earlier years, we take the more for tax purposes, but later on it reverses and we're taking what? More for book purposes, but by the time you get out to that last year, it nets out to what? 5,000 more for book purposes than tax purposes will be future taxable amounts. Okay? So as this starts to reverse, what's your name again? Sinas. As this starts to reverse, we'll start to debit the deferred tax liability, won't we? Okay, right now it's the total difference, right? But over time, that's going to start to reverse out, and as that reverses out, we'll start to take away from that deferred tax liability. So by that last year, it's zeroed out, right?
I just don't understand how we calculate the depreciation difference for that year.
Well, the depreciation in both cases is going to be the full amount of the asset. I guess they assume no salvage value here, which made this easier for us. So we have, how much did they buy this asset for? $20,000. Okay, and if you look at the depreciation amounts, 4 years times, what would that be? 5,000 a year, right? Will equal 20,000, right? Nice. So we're going to depreciate it in its entirety over the 4 years, right? Taking 5,000 a year. And when we sit here and we look at the percentages under the tax purposes, this is 100%, isn't it? So in both cases, the total depreciation is going to be what? Is going to be 20,000. Okay? But the difference is that what? That as this goes along, we will have at the end that last year in which we will take more depreciation for book purposes than tax purposes, right? So since we're going to have to catch ourselves up in that year and pay more tax in that year than what our book income would indicate we're going to have to take as tax, that's a deferred tax liability, right? Okay. And so we set that up, and then as we go along and this thing starts to reverse, and it could be in the second year, my deferred tax liability will increase a little bit. And then what? Probably by about that third year, the deferred tax liability starts to decrease as that timing difference starts to reverse. I mean, we can do the next year, I think. Can we? No, because I don't know the book income for the next year. So I can't really do that next year, but whatever the book income would be, the difference would be, because I can't get my tax my income tax expense, but the tax payable, but that next year we're going to have a difference in the depreciation of what? 25, so there's going to be a 5% difference. In the depreciation on the 20,000. So 5% times 20,000 gives us what? 1,000? So there's $1,000 difference in which we're going to take what? In that next year, we're going to take more tax depreciation than book depreciation, right? But by that next year, what happens? By that next year, now we're going to start to reverse that as what? As I start having it, and it swings back the other way, 5%. So I'll have $1,000 more depreciation on my book than the tax, right? So that'll start to back out. And that completely reverses out at year 5, where it swung all the way back the other way. So when you net these out, there's a $5,000 more of book depreciation that I have to go than tax depreciation, and that is going to generate this timing difference, this deferred tax liability.
So that subtraction, the 20K times 25 is the book depreciation, and then the 50% times the 20K, that's the tax depreciation.
That's the tax depreciation that's giving me my taxable income. That's how I came up with my, kind of written all over it now. That's what gives me my taxable income for the first year of this, right? Because I had to get that to figure out my current tax liability. But then I'm saying, as the way these things work, it goes along and it finally reverses out, right? So if you look at the entire, whatever it is, 3 years here, that last, in that fourth year is when it will finally turn around and I'll have more taxable income than I do book income, right? And that generates a deferred tax liability. Okay? Questions?
Do you want to do the 2019 depreciation difference? The third year.
Well, I can do it for all the years. I'll do it on the board. I can't calculate the deferred tax liability because I don't know what the the whole journal entry because I don't know what the tax is. But if I look at year, what was it? When this whole thing started? 2017? Huh? In this example, 2017? Okay, so for 2017, just to, extend out the numbers, I have what, 10,000 depreciation for tax, and I have, 5,000 depreciation each year for book. Maybe I'll do it this way. So this is 2017. Okay, and so we have that difference, and that's say what? I'm going to put the tax on this side. It's 10,000, and I'll make that subtract. And book is what? Book is 5,000. And so for 2017, I have a what? $5,000 difference, right? Okay. Now when I get to 2018, book is again 5,000, and we said the tax is how much now? It's going to be what's the problem say here? 30% of the 20,000. So what's that? 6,000. Okay, so again, we've got what? We've got another 1,000 that has turned around here that is still adding to my deferred tax liability, right? And then when I get to 2019 is going to go ahead and again book it's going to be 5,000 and tax is going to be what, 4,000? Okay, so the tax is 4,000. So now what's happening? Now my deferred tax liability has there's $1,000 difference towards the book. So now my deferred tax liability is down to this 6 minus 1,000, right? Right, so it's what, 5,000? Okay, and that 5,000 is when this thing is finally going to what? Completely turn around on me in that last year. Okay, because in the last year, 2020 now, I'll do what? I'll take 5,000 for these purposes and nothing here, right? And so that will turn around 5,000. So the future taxable amount is this what? This 5,000 sitting right here. I'll have to pay tax on, $5,000 more of taxable income than book income in that last year. That's what generates the deferred tax liability. And as I start getting into these years, that deferred tax liability starts to turn around, doesn't it? Okay. Question? I guess the other way you could look at it is right here is my future taxable amount is 5,000 at the end of 2016, right? I guess would be the other way to look at it. The end of 2017, my future taxable amount is 5,000, right? Would be the other way to look at it. And sure enough, here it is, that future taxable amount. Okay? Am I going to have to pay tax on this extra 5,000 at some point? At the end of 2017? Difference between book and tax? I'm going to have to pay on that, right? Is my future taxable amount. And the way I was showing it to you was this way. I guess this is more the proof that that's a future taxable amount. This is when this evens out, right? In that last year. Okay? Question? So what do you want to do about Monday then? Monday, I can stop this. We don't need to record this.